No money. Can't get a loan. Oh, I'm sorry. I forgot I was recording. However, with that being said, thank you for watching today because we're talking about DSCR loans. No money. Actually, no money. No money is very bad, right? Because on these loans, you do need money, but no income, no worries. We can still get you a loan. And how are we going to do that? So you're looking to buy an investment property. You're self-employed, you got a lot of money saved up, or you may have gotten a large inheritance and you want to put it somewhere, however your income's not that high. This is how we're going to get these loans. And these are called DSCR loans, debt service coverage ratio loans. And what is a DSCR loan? A traditional loan is going to have income verification, asset verification, and credit verification with debt to income ratio. However, if you have the assets, which is the money, however, your debt to income ratio may be a little higher, or you have a lot of write-offs on your tax returns, or you're just like every other business owner out there who does make a good amount of money, however, you want to write off as much as you can because of expenses, then this may be the loan for you. The way that these loans work is it's debt service coverage ratio. Instead of qualifying you off of your traditional income, we're qualifying you off of how much the debt service can cover. Let's just say we are buying a home that is giving you $1,000 a month mortgage payment. We're gonna have debt service coverage ratio at 1.5, which is gonna probably give you the best rate, 1.25, which is gonna give you a little higher rate, 1%, which is like $1,000 a month mortgage payment, and $1,000 a month coverage, which is how much rent can be collected. 0.75, so if you have that $1,000 a month mortgage payment, the rent coverage is $750. Or if it's just totally off the charts, like you're buying a very expensive house, then you're gonna possibly go with a no ratio loan. That means, hey, you've got the assets to kind of put into this and you got enough cash reserves, then we know that we can lend you the money and you have that rainy day fund to kind of cover it all. So debt service coverage ratio loans, that's what it is. How do these loans work? They typically work with like investment properties only. With the investment properties, they can be put into LLCs to kind of protect you. And the more protection that you have, I would say, the higher the rate. Your more traditional investors are going to want like houses that are fully coverable by like, VA, FHA, or conventional entities. And what I mean by that is if you're buying a home that's like a non-warrantable condo, something that's not approved through the other agencies such as VA, FHA, or conventional, this may not work. Also, some of the other things to look out for are like if you're buying something that's a little more rural. If you're buying something that's a little more rural, then you're going to knock out, a large majority of the DSCR investors. Who this loan is perfect for, like I said, is going to be an investor that wants to build a rental portfolio or even cost segregate, which is like, accelerating all of the depreciation up front, or someone that just, doesn't have that income to qualify and they want to invest in properties. A good DSCR ratio, I would say the good rule of thumb is to kind of go and talk to your loan officer, see what the down payment requirement's going to be in order for you to meet that monthly payment that you're comfortable with. And at that point, also check with a real estate agent to make sure that they're giving you rental comps, rental comparables, so that you see what type of rental income you can collect. The good thing about these loans with the DSCR is that irregardless of it being a single unit, a duplex, a triplex, or a quadplex, they're going to use the same type of factors. And a lot of times, a lot of these loans will be allowed, you could actually finance those multi-unit properties with less money down. One thing that you have to take into consideration is when we're factoring the debt service coverage ratio for you to purchase, it does not include some of the other expenses that you need to count when you're calculating your net operating income. Those things are such as, your utilities that are going to be needed, right? I have a swimming pool at one of my properties. So the maintenance costs in a swimming pool, the power, all the other things that kind of go with it. You have to take all that into consideration. Your yard maintenance, even pressure washing, maintenance that has to be done around the house in between investors if you're operating it as a short-term rental, or if you're doing it as a long-term rental, like, carpet has to be replaced after X amount of years. Things like that really have to be taken into consideration. And we don't do that as the lender. We don't take all that net operating expenses into consideration. To qualify, typically the minimum credit score for a DSCR loan could be as low as 600 and even 580. Different investors, different lending institutions are going to have different criteria for all of this. And obviously, you know, with the lower credit scores, they are going to be higher rates, and it's going to be harder for us to qualify for a debt service coverage ratio. So make sure you're working on that, you know, with your loan officer. We actually have a internal, like kind of exclusive to us credit attorney that we work with. And, you know, they typically will take a look at a credit report and say, hey, you know, if we get this credit score from the 620 range to like a 660, this is how much we would save. And this is the cost that's associated with doing business with the credit attorneys. And, you know, we can weigh it all out to see if it makes sense for you. The steps that you're going to have to take to apply for this loan are do the application online. Once the application's completed, we have to verify your assets. Okay, we have to verify that you have assets. If you have any additional properties, we have to know all of the properties that you personally own or your entity owns, because we have to count those expenses that are in against you. But more importantly, we're going to have cash reserves for each one of your properties. Once we go through underwriting, they're then going to review everything that's submitted to us. So no income verification. And then we're waiting for that appraisal to come back. And that appraisal is going to have a rent comp schedule in there. That's going to tell us, based on surrounding properties, this is the type of rent that you can collect. And if you want to challenge it, you can challenge it. If you don't want to challenge it, then you can kind of go through with it. With that being said, you know, those appraisal costs are a little more expensive because it does have a rental comp schedule in it, which is extra work for the appraiser to do. These loans do cost a little more because there's more risk from the lender's perspective when we're taking a loan like this. We're not looking at your income, so we have no idea what your income is. All we're looking at is the debt service coverage ratio. And the fact that we could put these loans into LLCs up front to protect you from personal liability typically is going to have an additional add-on to it. There's a lot of different rate sheets. There's a lot of different add-ons and adjustments when it comes to these loans. So you really need to shop around, talk to your loan officer, make sure that this program is something that you're comfortable with from a monthly payment standpoint, a vacancy standpoint, a net operating income standpoint, and a cash to close standpoint, because those are really, really important. So if you have any questions or concerns at all, my name is David Xie. I'm with the Xie Mortgage team. I can be reached at 757-478-8493. We are the world's largest wholesale mortgage broker, so we have more options than any other lender out there. So we have more DSCR products than everyone else out there. We have more conventional VA, FHA investors that we can go to. I'd love to help you out. So I will talk to you later.